people will be looking around for something else which is on the move. And if gold is on the move, probably because China and other central banks are buying, they may see that as an attractive option. Now, the distance by which gold can move upwards is pretty large. If I was to put a target on gold for gold next year, I think we will see a 3,000 price at some point. That's more than 10% above today's price, I think.
The growing demand for gold reflects a global trend among central banks to diversify their reserves and reduce dependence on traditional assets like the US dollar. Despite elevated gold prices amid market volatility in 2024, China remains unwavering in its commitment to increasing its gold holdings. Last year, gold prices soared to record highs, driven by a combination of factors, including monetary easing in the United States, heightened geopolitical tensions, and robust central bank purchases across the globe. This persistent focus on gold underscores its enduring role as a vital asset in navigating economic and political uncertainties. Market expert Clive Thompson remains bullish on gold. He suggests that investors will increasingly seek alternatives with strong upward momentum as market dynamics evolve. Thompson predicts that gold prices could reach $3,000, driven partly by continued purchasing from China and other central banks. The People's Bank of China, PBOC, the nation's central bank, increased its gold reserves to 73.3 million ounces in December 2024, up from 73 million ounces in November, according to State Administration of Foreign Exchange data. This marks the second consecutive month of growth in gold holdings. China's foreign exchange reserves remained steady at $3.2 trillion at the end of December 2024, maintaining this level for the 12th consecutive month, official data revealed on Tuesday. Notably, 2024 marked the third straight year of expansion in China's gold reserves, underscoring its ongoing commitment to strengthening its gold holdings. Clive Thompson identifies central bank buying, led by China, as a current key driver of gold prices. He anticipates that this trend will persist and gain momentum in the future. Thompson expects this shift to be exceptionally prominent among non-European central banks, particularly those with less direct alignment with the United States. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think one of the big drivers for the gold price at the moment, and there will be others down the line, is the central bank buying. And China is leading the way here. We've seen in December that China increased its gold holdings. It bought more than double the amount in December that it bought in November. As far as China's reserves are concerned, over the last 24 months, 80% of the increase in its reserves are represented by an increase in gold. Now, that's partly due to gold purchases, and it's partly due to the rise in the gold price. So 80% of that, their rise in their foreign reserves, is basically due to gold. Now, that's telling me that they rather like gold, but the figure gets even more extreme if we look over the last 12 months. Over the last 12 months, the value of their reserves, or the value of the gold in their reserves, was 5 times the amount by which their reserves increased. So there's been a very significant shift in China's gold reserve holdings over the last 2 years. They've gone from about 3-point-something% to 5-point-something% in 2 years of their total reserves in gold. They're still a long way behind the United States in terms of the amount of gold they hold. I think the USA holds about 5 times as much gold, or 4 times as much gold as China holds. So there's
Allegedly.
a lot of buying they could do. Well, yes, of course. This depends on whether you believe the numbers, but we haven't got anything else to go. We have the official numbers. I'm not saying I believe them or disbelieve them, but that's all we've got to go on. But according to that, they don't have anywhere near as much gold as the United States, but they're going very, very fast in the direction of increasing their gold reserves as a percentage of their total reserves. So I see that continuing, but more importantly, I also see other central banks looking at what China's doing and saying, maybe we should also be reducing our exposure to the dollar what are we doing supporting the US dollar? Well, we should be looking after ourselves. And the way you look after yourself, if you're a central bank, is to own something which is nobody's liability, not the liability of the United States, which at the moment isn't showing any signs of balancing its budget, isn't showing any signs of taking action to rein in the increases in its national debt. So I think more central banks, probably not the European ones, but certainly the ones which are maybe I won't say on less good terms, but maybe not on as good terms as some European countries are with the USA, will probably be looking to look after themselves, and they'll be buying gold instead of treasuries.
The past year has been exceptional for gold and silver, with silver posting an impressive gain of over 30%, emerging as a top performer in the commodities market. The persistent gap between demand and supply essentially drives this surge. Valued for its dual role in industrial applications and investment, silver is well positioned to benefit from the growing emphasis on renewable energy, particularly in solar technology. However, subdued global manufacturing activity and a strong US dollar may introduce volatility and limit silver's potential gains in 2025. Clive Thompson highlights that silver is undergoing distinct dynamics separate from gold, driven by significant supply and demand imbalances that he believes will propel prices upward. He explains that recycling efforts and investor disinvestment offset the widening production deficit. Now, let's redirect our attention to a video.
So we'll come on to what happens next with gold in a minute. But silver's got its own dynamics. We've got a situation where for the decade which has just gone by, we've seen year after year the volume of silver, the number of ounces of silver being produced by the mines going down. The reason for that is a lot of the silver which is produced is a byproduct of other metals. We've also seen for the last decade the consumption of silver, including investment consumption, increasing. But if you strip out the investment consumption, we had a crossover about 2 years ago in 2021 or 2022 when the industrial use of silver exceeded the mine supply for the first time in, well, at least in the decade, which you can see on the Silver Institute's website. That deficit of silver got larger last year, and its forecast for that's 2023, and its forecast for 2024, they haven't got the final figures in yet, to have grown much bigger. The reason the consumption for industrial use is rising is due to electrical demand. According to the estimates, demand for silver in electrical use, which is the biggest use of silver, rose by 20% in 2024 and is projected to continue rising rapidly. The simple reason for that is we're not going to have any less electronics on the planet, and the smaller your electronics get, the more you need silver in them rather than copper. So we're in a world of microelectronics. We're in a world where we will have more electronic devices, and that consumption of silver in the electronics industry continues to rise and will continue to rise. But there's literally no sign yet whatsoever of mined production of silver rising. It's actually falling according to the official numbers. So where's the difference coming from? As we now have a deficit of silver being produced every year, the difference which has to be brought into the market is coming out of recycling and disinvestment. Investors have been selling their silver, their bars, and there are companies around which are melting down electronic products and other things which have got silver in them. Of course, pawn shops and so forth. Grannies are bringing their candlesticks or old silver knives and forks to have them melted down too. So that's where how the balance of silver is made up to fill that gap, that deficit gap. But of course, to keep on sucking out that recycled silver, you need a higher price, especially as the deficit between mining production going down, industrial consumption going up. As that deficit grows wider, you need to have more silver sucked out of the marketplace for recycling, and that pushes the price higher.
Gold and silver are becoming increasingly significant in the global market, fueled by central bank buying and rising industrial demand. especially in renewable energy technologies for silver. Gold remains a safe haven asset amid geopolitical uncertainty, while silver benefits from its crucial role in electronics and solar energy, along with a supply-demand imbalance. However, both metals face challenges, including a strong US dollar and weaker global manufacturing activity. Despite this, long-term demand from central banks and industries suggests their continued growth and relevance. How do you see the role of gold and silver evolving in the coming years? Join the conversation. Share your thoughts in the comments. Give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.